It started with a single announcement. President Trump said the war between the United States and Iran was on pause. Within hours, oil prices dropped sharply. For most people, that sounds like good news. Cheaper oil usually means cheaper gas, cheaper groceries, and lower prices across the board. But this time, something felt different. Analysts noticed that prices weren't falling the way they normally would, and many everyday investors were left confused about what was really happening. To understand why, it helps to look back at how this year unfolded. In February, the United States launched a military operation against Iran, known as Operation Epic Fury. The moment that happened, oil prices jumped and the stock market fell. By March, the fighting continued, and oil climbed above $100 a barrel. News outlets began warning that prices could reach $200 a barrel and that gas could cost as much as $10 a gallon in some parts of the country. Then, in early April, the situation shifted again. President Trump announced a ceasefire with Iran. Oil prices fell by around 15% in a single day. Traders who had bet that prices would keep rising suddenly lost money. It seemed like the crisis was over, but it wasn't. Just a few weeks later, the ceasefire broke down. Fighting resumed, and oil prices climbed to their highest point of the year. Strangely, the stock market didn't react as strongly this time. It stayed relatively calm, even as oil surged. By June, people began to believe the conflict might last longer than expected, and oil prices started slipping again. Gas prices followed, giving families a small break. That relief didn't last either. In July, just as prices were finally coming down, the ceasefire collapsed once more. Oil surged, the stock market fell, and the cycle repeated itself for what felt like the fifth time that year. Then, only days ago, another pause was announced. Oil dropped again, and once again, traders who had bet on rising prices lost money. This pattern repeated 6 separate times in a single year. Each time the market reacted the same way. Fear, followed by a sudden reversal, followed by more fear. For professional traders and everyday investors alike, this became an exhausting cycle. Analysts who study market behavior say this reveals something important. When people try to guess what will happen next based on news headlines, they are not really investing. They are gambling. And in a situation this unpredictable, even experienced traders struggle to stay ahead. The reason this kept happening comes down to how connected global oil markets really are. Every time fighting broke out, supply concerns rattled markets around the world. Every time a ceasefire was announced, those same markets calmed down, only to be shaken again weeks later. Because no one could predict when the next shift would happen, traders who tried to time their moves based on the news often found themselves on the losing side. To understand why oil prices behave the way they do, it helps to look at a few key facts most people never think about. The first one is simple, but powerful. The United States is now the largest oil producer in the world. Not Saudi Arabia, not Russia, the United States. Over the last 20 years, the country has become far more energy independent, producing much more of its own oil than it used to. This matters because it explains why gas prices in America, while painful at times, never reached the extreme levels the news kept warning about. Predictions of $10 gas never came true nationwide. That's not luck. It's because domestic production gave the country a cushion that other nations simply don't have. The second important fact is that oil is a global commodity. When oil prices rise in one part of the world, they tend to rise almost everywhere. This is where a place called the Strait of Hormuz becomes critical. This narrow waterway is one of the most important routes for oil shipments on the planet. A massive share of the world's oil passes through it every single day. When the conflict with Iran escalated, there were threats to block this strait entirely. If that happened, oil supply would drop sharply, even though demand for oil around the world hadn't changed at all. Basic economics explains what happens next. When supply falls but demand stays the same, prices go up. That single geographic choke point helps explain why a regional conflict could send shockwaves through markets everywhere, even in countries with no direct connection to the fighting. In response to the supply threat, the United States and a group of oil-producing nations known as OPEC worked together to increase output elsewhere. Their goal was to flood the market with more oil, offsetting the losses caused by instability near the strait. This is one of the reasons prices, while volatile, didn't spiral completely out of control. Behind the scenes, adjustments were being made to keep the global system from breaking down. But there's a deeper layer to this story that many viewers might find surprising. If the United States doesn't rely heavily on oil from the Middle East, why does it care so much about protecting the Strait of Hormuz? The answer has less to do with American oil needs and more to do with China. China depends heavily on oil that flows through this exact region, including supplies from Iran. And China and the United States are engaged in a different kind of conflict, an economic one. Both nations are competing for global influence, and energy has become one of the quiet battlegrounds. By disrupting the flow of oil through this region, the situation indirectly limits how easily China can access cheap energy, which affects how competitively Chinese businesses can operate on the world stage. This is where the oil story becomes something bigger than just gas prices at the pump. It becomes part of a larger ongoing struggle between two global superpowers, one that most viewers never hear discussed in simple terms. Tariffs, technology restrictions, and now energy access have all become tools used quietly in this rivalry. Understanding these rules, how supply and demand work, how the Strait of Hormuz shapes global oil flow, and how energy connects to the broader competition between the United States and China, gives viewers a much clearer picture of why prices move the way they did. It's not random, it's not simple bad luck. It's the result of overlapping forces working together, some visible, some hidden beneath the surface. Every price swing tells a story about who wins and who loses. When oil prices spike, it isn't just felt at the gas pump. Businesses that rely on fuel and transportation face higher costs almost immediately. Airlines, delivery companies, and manufacturers all absorb these costs first. Eventually, much of that expense gets passed down to ordinary people through higher prices on everyday goods, even ones that seem to have nothing to do with oil. This is one of the most misunderstood parts of the story. Many people assume that when oil prices fall, life gets cheaper right away. But businesses that already paid higher prices for oil and materials don't always lower their prices immediately, even after the market shifts. That means families sometimes wait weeks or months to feel real relief, even after headlines announce that a crisis has passed. This lag creates frustration and confusion, especially for people trying to plan household budgets around unpredictable swings. There's also a human cost that goes beyond economics. Repeated volatility creates stress and uncertainty, not just for large investors, but for everyday people managing retirement accounts, small businesses, or family savings. When prices swing wildly 6 times in a single year, trust in stability itself begins to erode. People start to feel like the ground beneath their financial decisions keeps shifting, making it harder to plan confidently for the future. On a larger scale, these consequences ripple into the ongoing rivalry between the United States and China. Every disruption to the flow of oil through the Strait of Hormuz doesn't just affect global prices, it also weakens China's ability to secure cheap, stable energy. Since affordable energy allows Chinese manufacturers to produce goods at lower costs, any disruption makes it more expensive for them to compete internationally. That gives the United States an indirect advantage in a competition that isn't fought with weapons, but with economic leverage. This connects to other quiet moves both countries have made in recent years. Tariffs were placed on Chinese goods, partly to encourage manufacturing to return to the United States, and partly to pressure China's economy. Restrictions were placed on advanced computer chips, technology that is essential for the growth of artificial intelligence. China responded by limiting access to certain rare metals and minerals that other countries depend on. Each of these moves, including the disruption of Middle Eastern oil supply routes, forms part of a larger pattern, 2 of the world's largest economies maneuvering against each other in ways that rarely make headlines, but carry lasting consequences. For everyday viewers, the deeper lesson is this. Global events that seem distant and unrelated to daily life often shape decisions much closer to home. A conflict overseas can influence how much someone pays for gas, groceries, or even a plane ticket. It can affect job stability in industries tied to manufacturing or energy. It can quietly influence interest rates, investment returns, and long-term financial planning. Different perspectives exist on how to interpret these consequences. Some argue that increased domestic oil production has protected the country from far worse outcomes, pointing to the fact that gas prices, while high at times, never reached the extreme levels once predicted. Others argue that continued instability shows how fragile global energy dependence remains, even for a country with strong domestic production. Both viewpoints highlight a similar truth. Energy security remains one of the most important yet overlooked factors shaping economic stability. What becomes clear is that these consequences aren't isolated incidents. They are part of an ongoing, evolving relationship between global politics, energy supply, and everyday financial well-being. As the story continues to unfold, understanding these deeper implications becomes essential, not just for investors, but for anyone trying to make sense of why prices and markets behave the way they do. So where does this leave everyday people trying to make sense of it all? After 6 major swings in a single year, one thing has become clear. Trying to predict the market based on news headlines is not a reliable strategy. It's closer to gambling than investing. And yet, many people continue to make financial decisions this way, reacting to fear one week and excitement the next. This raises an important question we're thinking about. How often are financial decisions being made out of emotion rather than research? It's easy to feel pulled toward buying when prices are rising fast, or selling in a panic when they crash. But history has shown again and again that reacting to headlines rarely leads to lasting success. By the time a story is widely reported, much of the movement has often already happened. Looking ahead, there are still important developments to watch. The relationship between the United States and Iran remains unpredictable, and further shifts in that conflict could continue to affect oil prices in the months ahead. At the same time, the broader economic competition between the United States and China shows no signs of slowing down. Decisions involving tariffs, technology restrictions, and energy access will likely continue shaping global markets in ways that aren't always obvious at first glance. There are also smaller, less discussed developments worth paying attention to. For example, disruptions to resources like helium used in the production of semiconductors could quietly influence industries tied to artificial intelligence and technology in the future. These are the kinds of details that rarely make headlines, but often matter more in the long run than the loudest news stories of the day. For viewers trying to navigate this kind of uncertainty, the most valuable approach isn't chasing every headline. It's building financial habits based on research, patience, and consistency. Instead of trying to perfectly time the market, many long-term investors focus on steadily building their positions over time, regardless of whether prices are up, down, or sideways. This approach won't make headlines, and it won't feel exciting in the moment. But over long periods, it has proven far more effective than reacting emotionally to every twist and turn in the news. Staying informed matters too, but there's a difference between staying informed and reacting impulsively. Following credible sources, understanding the reasoning behind major decisions, and looking at the bigger picture can help viewers make steadier, more confident choices. Rather than asking, what is the news saying right now? A more useful question is, what does this actually mean for the future, and how does it fit into a longer-term plan? As this story continues to develop, viewers are encouraged to think critically about what they hear and read. Not every headline deserves a reaction. Not every price swing requires immediate action. Sometimes, the wisest move is simply to stay patient and keep a clear, long-term perspective, even when the market feels unpredictable. What do you think? Do you believe this pattern of unpredictable swings will continue, or is calm ahead? Share your thoughts in the comments below. This story is a reminder that behind every headline lies a much bigger picture, one shaped by global politics, economics, and decisions made far beyond the daily news cycle. Understanding that bigger picture is what separates reactive decision-making from thoughtful, long-term planning. Thank you for watching this video here on Currency Matrix. If you found this breakdown valuable, consider subscribing so you don't miss future stories that go beyond the headlines and into what really matters for your financial future.